And I am stopping the transcription. Or do we want the transcription? No. Let's stop the transcription. Okay. Very well. So good evening. A few words on the webinar series, of which this is the first appointment, the first event. It is a webinar series, as you have seen from the program, dedicated to a perspective from financial history on central bank digital currencies. It is conceived and promoted in the context of a research project funded by the European Union and the Italian Ministry of University from the Programma Nazionale di Ripresa e Resilienza. And the principal investigator of this research project is Carlo D'Ippoliti, whom I mentioned before, of Università La Sapienza, who will be joining us shortly. Just very few words to introduce the cycle. Our idea was to pick up the debate concerning cryptocurrencies and central bank digital currencies, which has had the merit of raising a series of questions that had been long forgotten, at least within economics as a discipline, concerning the nature of money and how money is issued, how the monetary policy is shared between public and private actors, and so on. And we wanted to give all these issues a historical perspective, asking colleagues who have variously contributed to these reflections over the years to give their perspective and their understanding. So in this context, we are very glad to welcome this evening as a speaker Stefano Sgambati, who is a senior lecturer in international political economy at City University London. He is an expert in the political economy of financial markets, of financialization, and of the more recent evolutions in the functioning of financial markets. And with Stefano, we really had the pleasure, which is, I would say, one of the greatest pleasure for those who do our job of researching, to find an extraordinary convergence in paths of research that have followed different streams, but eventually come to very close interests and to very close conclusions. So we're very happy to listen to him. I am speaking here also on behalf of my colleague and co-author Massimo Amato, who will act as a discussant. So before leaving the floor to Stefano for his presentation, just briefly remind all of you, or rather tell you, since this is our first appointment, the rules of the game. Stefano will have roughly half an hour for his presentation. Then we will turn to Massimo for his comments for roughly 10 minutes. And then we will have the rest of the time, at least 20 minutes, but as long as you can remain with us, up to maximum 90 minutes for Q&A and a broader discussion in which you are more than welcome to participate, both raising your hand and intervening, and using the chat, which I believe is activated and accessible to all. But without further ado, let me once again thank very warmly Stefano for having accepted this invitation to inaugurate the webinar series, and leave the floor to him. Please, Stefano, and thank you once again.
Thank you very much, Luca. I've just now realized that Leonardo DiCaprio was the whole time on the screen. I never stopped sharing the first slides. Thank you very much for inviting me to present this webinar, and I will immediately say, just to clear the space, that I have been a big fan of your work, of the work of the two hosts of this session. I first came across your co-authored book, The End of Finance, 10, 11, 12 years ago, towards the end of my PhD. and immediately you guys entered my personal imaginary all-star team of all the best top scholars of money and finance of all times. And so it's really a pleasure and it's an honor to be here presenting today and to have Massimo as a discussant of my work. So thank you very much. And but I'll stop sweet talking my discussant, and I will go immediately to my presentation. So what I'm presenting today is essentially an article that draws on 3 chapters of a book that I've been writing for about 1 year. And this article is titled The Invisible Leverage of the Top 1%, Absentee Debtors and Hedge Funds and their hedge funds. And absentee debtors is also a concept that will be very prominent in the book, although I'm not quite sure what the title will be, but this book will tackle questions of power, conflict, class inequality within global finance and financial markets, and it will do so through the lenses of leverage. So today I'm going to talk about leverage, in particular financial sector leverage, and who creates this kind of leverage, and therefore hedge funds and absentee debtors on the background. So let's get to it and try and make sense of what leverage is. So in my work, I've been describing leverage in very simple terms as a form of borrowing to invest. There are essentially 2 main reasons why people might wish to borrow. One is for consumption purposes, borrow to pay for their goods, services, bills, and so on. And the other thing is borrowing to invest, which I refer to as leverage, but it's a normal term that is used in the literature. And leverage is very different from consumption debt. Consumption debt is a form of this saving, whereas leverage is something that is finalized to acquiring assets, normally property or financial assets. And that means that leverage is likely to generate over time actually an increase in saving and in capital and wealth gains that can result from acquiring said asset through leverage. The other thing that is worth noting is that leverage, although is the product of borrowing, is not the same as debt. Debt is a fixed quantity. You borrow a certain amount of money and you owe it back. It's a fixed quantity plus interest that you have to pay. Leverage, on the other hand, is a ratio, a debt to equity ratio. So in this example, I'm showing a typical transaction, purchasing a house with a mortgage and using a down payment, an equity of £30,000 to acquire a property, a house, which is worth £300,000. The leverage ratio be 9 in the initial, in the original position, but 1 year down the line, the housing, the value of the property goes up 5%, and that means that if I were to choose to sell the house and realize a capital gain, I would make return on equity of 50%, because suddenly I will sell the house and repay the mortgage and have £45,000 in equity. My leverage ratio would have declined in the meantime, and I would have made a handsome return on my initial capital investment. Same goes if price goes down 5% or more. So a leverage ratio is a variable ratio, and it very much depends on the market value of the asset which is acquired by means of leverage. Now, when we look at financial sector leverage, it's roughly the same, except we're not dealing with housing, property, mortgages, and equity, but we're dealing with acquiring securities on a small margin or capital, and the rest being leverage or debt, which is usually short-term debt, and it's something that is accomplished through a range of different complex financial transactions, repurchase agreements, derivatives, contracts as well. And leverage in the financial sector transaction can be very, very high. So on the right-hand side, you can see a table with the sort of margin requirements that typically you would have to be able to open a position in a treasuries or on high yield bonds, equities, commodity futures. All of these are mostly derivatives-based forms of leverage that we see in this example, but it can be quite a lot, quite substantial. So very small margins. Now, financial sector leverage is the outcome of banks and big banks, broker-dealer banks, market-making banks, providing leverage services, credit, to a host of alternative financial firms or alternative investment firms. These are hedge funds, private equity firms, real estate investment trusts, and all these alternative financial firms, they make use of a lot of leverage, 1 to 10 times or more their equity capital, to invest in secondary markets, trading, investing in structured products, in derivatives, very exotic, sophisticated instruments which are not available to the average retail investors. They're only available to sophisticated investors, therefore people with a lot of money. And indeed, alternative finance is one of the preferred channels by high net worth individuals, the very wealthy individuals, multimillionaires and billionaires of this world. So we have alternative finance and traditional finance, which is investing other people's money without using leverage. In other words, investing the money as it is. It's a traditional form of financial intermediation, if you like. And this is done by the likes of traditional institutional investors, such as pension funds, mutual funds, and the new big asset managers like BlackRock, Fidelity, Vanguard, State Street, all these massive asset managers which hold portfolios of securities worth trillions, but they use very little or no leverage. This is traditional finance. Alternative finance is what it's done by the hedge funds and their friends. Now, my main claims today be 5. The first claim, which is probably the most controversial, it speaks directly to the title of this presentation, is that global financial economic elites are what we want to call them, the top 1%. Although it's not really the top 1%, it's what's inside the top 1%. It's most likely the top 1 of the top 1% or the 0.1%. They're not really creditors the way they're often described, usually described in the literature on finance and inequality and financialization. They're not a class of creditors. They're a class of absentee debtors. I call them absentee debtors. And I can also elaborate on why absentee debtors, but I'll say just a few things for now. They are the largest borrowers on earth. The second claim that I'm going to make is that today's financial relations, conflicts, and struggles are best understood not by using the lenses of the traditional creditor-debtor dichotomy, elite creditors versus mass debtors, with the rich lending to the poor, but they're best understood as debtor-debtor relations. As I often say, the greater debtors versus the lesser ones. The greater debtors are the ones who mostly borrow to invest, and they use leverage. They are the upper classes, top 20%, top 10% in any income distribution, if you like. And most of that debt is very visible. It's household debt, and it's mostly for purposes of financing the acquisition of property, real estate. But within the greater debtor, there's a very small fraction, elite, of absentee debtors. They are within the top 1%, and they mostly borrow by invisible means. That's why they're absentee in many ways. And then you have the lesser debtors. The lesser debtors are still borrowers. They're borrowing to pay for their bills, utilities, and so on. And sometimes they're not even borrowing themselves, but they're still paying to fund and subsidize a whole cultural leverage that is generating profits for others, not for themselves. So they're still paying for the high rents, high consumption costs, for the taxes that they cannot avoid and evade the way absentee debtors do, and so on and so forth. So the third claim is that absentee debtors do not really borrow from banks the way normal people do, the way normal households do, including upper class households. But they instead borrow through the leveraging practices of big banks, hedge funds, private equity funds, all these alternative investment funds, as well as all sorts of non-financial corporations, which also borrow, of which they are dominant shareholders and foremost beneficiaries. The fourth claim that I'll make is that today's banks, and I'm mostly looking at big banks, so the global big banks that serve as global market makers, broker dealers, and so on. They create money endogenously, meaning they create money out of nothing, out of nowhere. Also, when they lend to these alternative investment firms, as well as when they do proprietary trading and other things. And this type of market-based money creation is what's fueling financial sector leverage. And finally, the fifth claim, if I can manage to touch on this, is some of the largest and most levered up hedge funds in the world make record profits, annualized 30% return out of portfolios of safe assets. They generate record profits out of holding portfolios of G20 sovereign debt securities, US Treasury bonds, and so on. And the reason why they can generate record profits is precisely because they can apply a lot of leverage in holding those portfolios. So they have a lot of bang for the buck, as they say. So my understanding of money and finance very much draws on my understanding of banking and money creation. I'm not going to spend a lot of time on this because I believe that we're all on board with this. There are two main views of banking: traditional view that sees banks as pure intermediaries, and then there's the heterodox view that sees banks as creators of money, creating money as they make loans. Now, this view for a long time was a fringe view held just by heterodox post-Keynesian economists, but nowadays it's held by major economists at Bank of England, Bank for International Settlements, IMF, and so on. However, there is still a lot of undecisiveness around the question of whether big banks create money also when they finance these alternative investment funds, also as they enable the liquidity provisioning of financial markets through their capital market lending, through their capital market trading, and so on. And so nowadays we could say that there's a new mainstream orthodox position that says commercial banking is money creation. However, market-based banking, investment banking, shadow banking, that's still pure financial intermediation. And the new heterodox position would be the one that I am proposing today, which is to say that banks, big banks, actually create money endogenously as they finance other financial firms, including themselves. And that's roughly how it works. Big banks, these broker-dealer banks, market makers, they generate new purchasing power and expand their balance sheets as they finance capital market investing. And they do so either as they trade on their own accounts through proprietary trading, or as they lend to alternative money managers, hedge funds, private equity firms, real estate investment trusts, and so on. These firms trading on the steroids of leverage fuel capital market inflation and generate capital and wealth gains. These capital and wealth gains produce income, which is saved in the money market. So it's not saved traditionally by putting the money in a bank deposit, but by investing in money market instruments, money market fund shares. Money market funds collect this cash income from global savers, including the cash reserves of hedge funds, private equity firms, and so on. So the cash that these alternative investment firms hold. And this cash is then deposited with banks, which offer safe assets as collateral for these deposits. So we have, again, loans creating deposits, except this is taking place in the sphere of financial market investing and saving. So that's what we have. Now, this view is completely at odds with today's characterizations of class, finance, and inequality. Because as I mentioned at the beginning of this presentation, this main view is that we have on the one hand elite creditors and on the other hand mass debtors. And one of the most prominent views regarding the dynamics of finance and inequality nowadays is the so-called saving glut of the rich argument, which is basically embraced both by mainstream economists and also critical social scientists, scholars, from the Marxist tradition, as well as from, other traditions. So it's a very entrenched understanding of today's financial relations, and this view basically says you have on the one hand top 5, top 1% income earners within any given income distribution, the global north, and they've been increasing their income shares over the past 40 years, and this has caused the saving glut, an excess saving by the rich. And this excess saving is being intermediated by the financial system to finance the liabilities of the non-rich, the bottom 95% of the income distribution. So this is the story of the rich lending to the poor. And because of the saving glut, interest rates have collapsed, resulting in cheap credit for the non-rich. Now, this is the story, and this story should be aligned with what I called the law of the diminishing marginal utility of usury. If it is true that the wealthy are making extra income because they're lending at interest to the non-wealthy, so that having declining interests for a prolonged period of time should lead to declining returns on capital and therefore a declining growth of the wealth stock of the rich. It goes without saying, if interest is the main channel by which income is accrued by the elites, low interest rates should lead to lower capital returns and a decline in the growth of the wealth stock. But that's not what we see. All main annual reports on global wealth and so on, this is the Capgemini Research Institute, but the Credit Suisse Wealth Report shows you the same. They all show how the wealth stock of the high net worth individuals of the very wealthy of the world is being growing on average during the years of zero interest rates, of actual negative interest rates, if we look at real rates. And the only 2 years in which the growth of the wealth stock has declined, so there was a decline in the growth, were 2018 and 2022. 2018 was the first time since 2015 in which the Federal Reserve managed to bring interest rates to 2.5%, and that meant real positive rates. And there was a stock market crash in December 2018. And 2022, as we all know, is when central banks started raising interest rates again to combat inflation. And these are the 2 years in which the wealth stock of the rich has declined. The growth has declined. Now, some unsettling facts about household debt, very quickly. Household debt, which is not invisible, it's very visible, we see it in the statistics and everywhere, is mostly incurred not to subsidize consumption, but to finance investment in real estate and housing. Most household debt is owed by higher income households, concentrated in the top quintiles of income distributions. And high income levels are associated with high leverage. The more income, the more leverage. And historically, over the past 40 years, and some analyses are actually showing over the past 60 years, the share of household debt owed by the top 5 or top 10% households has actually increased, not decreased. So all stories about financialization as the growing financial inclusion of the non-rich don't really meet the actual data that we get from the Office for National the Survey of Consumer Finances that is released every 3 years in the US, or main databases and data sets that we have in the EU and the UK as well. So the long story short is that the biggest savers are also the biggest borrowers. Now, leverage ratios really collapse at the very top of the income distribution. It seems as though when we reach the top 1%, the rich stop borrowing. But that's just, an illusion. Because I was saying before, the rich within the top 1%, they do not borrow from the banks. They borrow using the hedge funds and other financial firms. So that debts do not appear in statistics on household debt. That debts are what's creating financial sector debt and fueling financial sector leverage. Now, another big problem with this view of financial relations as creditor-debtor relations and a major methodological fallacy in the saving glut argument is that it's confusing saving with financing. Saving is a net flow, financing is a gross flow. Gross flow is like mixing oranges with apples. Now, Claudio Borro, who's not a fringe economist, but the head of monetary and economic department at the BIS, made this very clear 10 years ago in a series of papers, including with his co-authors. Saving is income not consumed. Investment and expenditures more generally require financing, not saving. And financing is a gross, not a net concept. Now, what this means is very simple. In the saving glut argument, you have a creditor and a debtor. Person A on the left-hand side is a debtor. She has no assets and $1,000 liabilities. She has a negative net worth. She's a net debtor or just a debtor from the saving glut perspective. Person B has 1.2 billion assets, 1 billion liabilities, and therefore a 200 million net worth. She is a net creditor or simply a creditor from the saving glut perspective. But it goes without saying, she is the one who's borrowing $1 billion. Now, this question of where this $1 billion comes from, this question never arises when we look at financial relations from a net-only perspective, and therefore we just look at net creditors versus net debtors. And usually these liabilities, including the gross assets, are not even in the personal accounts of the billionaire. They are on the balance sheet of some hedge fund that they own. So let's have a look at a hedge fund and try and make sense of this industry. So we were looking initially at the housing example. When we look at a hedge fund and how they invest, that's what we're looking at. We're looking at a balance sheet where on the one hand, you have a gross notional exposure of gross assets under management, which is the total assets that a hedge fund commands. And then you have, as liabilities, short-term debt, which is generated via repos, derivatives, trading, securities borrowing. And then you have NAV, net asset value, which is the same as synonymous with assets under management. And when we hear about the hedge fund industry, we often just hear about AUM, assets under management, net asset value. And we are told that the total assets under management of the hedge fund industry have grown from less than 500 billions in the year 2000 to 5 trillion in the beginning of 2023. What we do not hear is that the actual gross notional exposure of the hedge fund industry as a whole might be very much 5 times or 10 times the value of the net assets under management. So when we hear that the hedge fund industry has 5 trillion assets, it means that they have probably another 25 trillion in short-term debt that they've generated to make their investments and so on. And a lot of this leverage is off balance sheet. Some of it is on balance sheet, and it's called balance sheet leverage, and it's much easier to detect. But the vast majority of this debt is known as synthetic leverage or embedded leverage. And this is leverage which is embedded in derivatives contracts for the most part. Now I'm going to skip this example of how a balance sheet of a hedge fund looks, but I can return to that. Do I have another 5 minutes?
Sorry, Stefano. Yes, indeed. You have another 7 minutes. 8
Fantastic. Fantastic. So I've done a bit of study of the hedge fund industry, and I've looked at the studies out there produced, the literature that exists, and there isn't a lot, I must say. There are a few studies, but they're very authoritative ones. Some of these studies with very large samples of hedge funds, with thousands of hedge funds, covering, sometimes a total of, I don't know, 2,000 hedge funds controlling 3.5 trillion assets under management. So these studies are quite depicting, the picture here. And some of the things that I've learned is that the hedge fund industry is highly polarized one. We hear that, there are thousands of hedge funds, and that is true. But while there are thousands of hedge funds, most assets under management are concentrated in the top 10%, or the top quintile anyway. The top hedge funds, top 10% hedge funds, are also the ones who are borrowing the most. They're the ones responsible for the vast majority of the leverage that is generated by the industry. So they are the largest in size, they have the most assets under management, they borrow the most, and they're also the most levered up. So they borrow the most in relation to their equity capital. They also have the least illiquid portfolios, which suggest something that I'm going to reiterate later on, that they do not necessarily take higher risks. They invest in the most liquid securities as well, compared to smaller hedge funds. And the largest hedge funds are also the ones who are actually making the record profits. On average, 25-30% annualized return on their equity, or more. Well, you have the outliers. I'm going to show you a couple of outliers. Whereas, half of the funds in thousands and thousands of funds are making very small returns, or even making losses, like a quarter away from bankruptcy. So if you just look at aggregate measures, you'll find that on average, a hedge fund is not beating the market. You'll find that on average, a hedge fund has a very low leverage ratio, because you're putting together very small hedge funds with some very large hedge funds, which actually have the power to shape prices and markets and move them and make them as well. Now, measures of synthetic leverage are difficult to come across, but I've found some studies that do that. And what is mind-boggling is that hedge funds in the top 1%, so top 1% hedge funds, they have synthetic leverage ratios which are simply off the charts. 30, 60 times their equity capital. They are on a different league compared to hedge funds in the top 10%. Or hedge funds in the top 5%. So we're really talking about a handful of hedge funds which enjoy extremely high leverage ratios, and they have the largest assets under management. They make up the great bulk of the industry profits and assets. And among the hedge funds that have the highest leverage ratios, we find relative value hedge funds. Now, relative value hedge funds specialize in making arbitrage gains on different classes of assets, including sovereign debt securities, public debts, US treasuries. These are safe assets. And relative value funds in the top 10%, they have gross notional exposure, gross leverage, which is like 16 times their equity capital on average. And we're looking at top 10%, not top 1%. I can go on and mention a few more studies, but I guess I will just keep it, we'll just mention this one data here. Latest survey by IOSCO, the International Organization of Securities Commissions, found that the gross exposure of hedge funds in its sample was 7.8 times the net asset value or assets under management. And this was a very large sample. And the gross exposure of hedge funds sampled operating in the US was overall, in absolute terms, 22.7 trillion in 2018. Now, 22.7 trillion in 2018 was probably the same as the US public debt, and certainly more than the household debt in the US. So just these hedge funds in this sample with limited data, they were generating this kind of gross notional exposure. So these very large hedge funds with high leverage ratios, they make profits that don't make any sense. So I went through some of the full financial statements of some hedge funds which have to report to the UK authorities. So I looked at Man Group, Millennium Capital, Capital Investment, Goldman Sachs Asset Management, and I looked at their total equity, net asset value, and their profits and their return on equity. And for Millennium Capital and Capula, it's just incredible. It doesn't make any sense. It only makes sense if we factor in leverage. The only way they can generate this record returns is because of the huge amount of leverage that they employ. And this is also seen by looking at the net income generated by different classes of financial market participants. We have BlackRock in 2022 with a total assets under management of 8.9 trillion, the same as the Federal Reserve, basically, generating 6.7 billion in net income in 2022. Then we have Goldman Sachs, which is not even a big bank. It's not one of the big four, with only 1.4 trillion assets. This is a bank, not an index fund. And Goldman Sachs was generating 14 billion in net income. And then we have Citadel, one of the largest hedge funds in the world, with 63.2 billion assets under management and 16 billion net income, more than BlackRock, despite having net asset value, assets under management 144 times smaller than BlackRock. So clearly leverage is what's creating these record profits here. And again, it would just look at the pays that, this hedge fund manager received. Larry Fink in 2020 got 30 million in salary plus bonuses. But in 2020, some of the top hedge fund managers were making 3 billion, like 100 times more. So when we look at, and I'm going to stop here, when we look at financial markets and financial market participants, and we try and open up the black box that we call global finance, we should bear in mind that a lot of the emphasis is being given over the last 10 years has been given to traditional money managers, the big three, BlackRock, these passive asset managers, and so on. But these managers, they really employ very little leverage or no leverage, and they don't make the markets. They buy the markets, they lend them out, they make, all right profits. But the real profits, the real money is created and is made by the big banks and the alternative money managers that I've been describing. And they employ a lot of leverage. Actually, big banks also higher leverage than average hedge funds. And I'm probably going to stop here. I'm not going to talk about how they make money out of safe assets, but that was one of the most remarkable findings that I came across. And that makes tremendous sense. This is known in financial literature as the low beta anomaly. And it basically means that a fund that employs a lot of leverage and invests in assets which are safe and have low volatility and low yield generates higher return than a fund that employs less leverage but invests in higher yield assets. So you make more money by using a lot of leverage to invest in US treasuries than you would make by investing in emerging market bonds with less leverage. And that explains also why safe assets in times of crisis become the opposite of safe. They're safe in normal times, but then in times of crisis, they suddenly become the center of margin calls and fire sales and of deflationary processes that take place. But I'll stop it here. Thank you very much, and sorry for taking perhaps a little too long.
Not at all, Stefano. Thank you for this great presentation. Very striking, very stimulating. I will leave immediately the floor to Massimo for his comments and then open for the questions. I'm sure that there are many on the part of our participants. Please, Massimo.
Yes, thank you. Just a few comments and some questions for Stefano, with whom I already had a chat on this paper he's writing, which I think is very, very, very interesting, even outside the already important issue of understanding how the financial industry works, but also with relation with concerning the relation between finance and macroeconomics. So first question, you mentioned the omission of gross financing to the profit, if I may say, of net saving. No? But it seemed to me that this leads to a peculiar invisibility of finance in macroeconomics. And in the sense that we are forced, ignoring gross financing, to think of finance in real terms, which is not realistic because, you know, finance is about money and savings in macroeconomics are real savings. And so we have a problem. So put the question in an intriguing way. When Olivier Blanchard says that we know too little about the functioning and the role of finance in determining macroequilibria and disequilibria, should he think in this way? Should he include gross financing in his models? First question. Okay. Second comment and second question. When you have a substantial and concentrated role for leverage, I think that expectations too play also a crucial role. Now, you spoke about money makers, no, hedge funds as a market makers. Sorry, market makers. So. Mostly in terms of self-fulfilling expectations. If you have someone that leverage also an expectation, but can influence expectations, you have a loop which is very, 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 very dangerous, potentially very dangerous. So could you elaborate a little bit on the role of expectation and hedge funds as expectation makers? Second question. Concerning the last question issue, you mentioned the paradox of low beta, high alpha. This is clearly something that infringes the law of high yields, high risk, low yields. And the fact that the safe assets are involved is even more paradoxical in a sense. But to what extent this can really destabilize markets? Third comment and third question. How can we assess these practices, these new practices, in a sense, in the light of what I'm used to name the Keynes dilemma about financial markets? Let me just quote a passage of chapter 12. We are a century ago, but he says the development of organized investment markets, with the development of organized investment markets, a new factor of great importance has entered in, which sometimes facilitates investment, but sometimes adds greatly to the instability of the system. In the sense that the liquidity of investment markets often facilitates, though it sometimes impedes the course of new investment, new I should say real investment, because if you want, finance is about the possibility of facilitating real investment, real accumulation, no? Accumulation of capital goods. So these practices, do they facilitate, only facilitate? Do they create the risk of crisis through the leveraging, to the leveraging, or do they do both things? In a sense, they are in the dilemma. They are seen as far as leverage works, they facilitate, and then when expectation change, the leveraging arrives, and then crisis arrives. So, and what is the potential effect on real accumulation? Because we can, this is what we are also seeing. We witness a what can I say, a strong dynamics of Western financial markets, but a low performance of Western capitalistic investment in terms of real accumulation. So we have, simply to mention, China. China does not have access to financial markets, in a sense, no, does not have financial markets so developed as the West, but is real investment is especially in high-tech sectors, very high, and much higher than in the West. So what is the impact on real accumulation? And fourth comment and fourth question, can you elaborate a little bit? Because you said we should not concentrate ourselves on the ancient scheme of debtor-creditor relationship, but on the scheme of debtor-debtor relationship. But what are the distributional implications of this paradigm shift, if you want? So these are my 4 questions.
Okay, talking about leverage, your 4 questions, I have at least 5 on my notebook. So
yes, I leverage a little bit. Yes, but you know.
No, but thank you, Massimo.
As far as okay, as it works, is profitable. So
yeah,
okay,
I'm sure it will be profitable, and this is the reason why I, if you all agree, I will turn immediately the floor back to Stefano, because it seems you have laid already a lot of issues on the table. So I think it is best for Stefano to have a first reply here, and then collect further questions or observations, please.
Okay, thank you, Massimo, for your comments, spot on comments. I always struggle with presenting what I have prepared for my presentations, and usually I make a mess of a job. So thank you for these comments. So they will help me elaborate further some of the points. I wrote down your questions. So on your first, you have 5 questions, not 4. So your first question was on financing, finance and saving, and should we include gross financing flows in our macroeconomic and macrofinancial models? And the answer is obviously a resounding yes. Now, I am not a macro financial economist, but in what I can do is a little bit of balance sheet analysis, and that is already a lot, because through balance sheets we learn about this gross capital flows as opposed to just the net income flows. So balance sheet analysis is great, but it's also a limited tool, because as I was explaining in my presentation, a lot of the leverage that goes on in contemporary financial markets is off balance sheet. It is embedded in derivatives contracts, and so it's not accounted for on a balance sheet. So we need to also devise new tools to quantify this. And it's been a problem for macrofinancial economists working at major financial institutions, the IMF, the BIS. There are papers, working papers, that have attempted to assess synthetic leverage in financial markets. They all admit that it's very difficult to do so. Then on the question of the rule of expectations in these practices of borrowing and leveraging, and you mentioned how these how leverage can generate self-fulfilling expectations, and that's really key to understanding why leverage is not just about taking a bet with borrowed money, but it's really about gearing the market to deliver the kind of outcome that you wish for. If you have a very deep lever, you can shape the market towards meeting the outcomes that you want. So leverage is known to be pro-cyclical, which means that if a big lever is applied by one or several investors and their financiers, then leverage is likely to generate asset price inflation, and that is a self-fulfilling prophecy. And we've seen it over the past 40 years, how this has been the trend, asset price inflation. Then the third question was on the paradox of low beta producing high alpha. So just, to clarify, beta is a measure of volatility of an asset, whereas alpha is a measure of profitability of an asset. So a low beta means low volatility, and it's usually associated with low yield safe assets. High alpha, on the other hand, is a measure of profitability, which usually is associated with high beta assets, so with high volatility, high risk, high yield assets. So with leverage, we find the paradox of safe assets producing high yield, high alpha. And you were asking, to what extent can this truly destabilize markets? And the answer is quite a lot, because during as central banks started raising interest rates to tackle inflation between 22, 23, a lot of highly levered up funds found themselves in this predicament where they had to sell their safe assets to meet the margins because their cost of borrowing was going up. So they started selling the best assets that they had because those assets could be sold at the smallest discount. But that's produced the pension fund crisis in the UK in September, October 22, yes. And then the US banking crisis in between January and March 2023, where Silicon Valley Bank and other banks folded. And more broadly, US banks, particularly small banks, which do not value their assets on a mark-to-market basis, meaning they don't evaluate the value of the assets on a daily basis, but just on just their book value. Well, these banks have generated 1.7 to 2 trillion unrealized bank losses, meaning they were holding a lot of bonds, treasury bonds and their portfolios, old bonds, which were now trading at a discount. And if those bonds were to be valued at their market value, they would sell at 20 or 30% discount as well. And so that overall created this massive potential losses, which scared the shit out of a lot of savers and depositors, and a major exodus of funds away from small banks and towards the big banks, which are safer in that sense. And that is in itself something, that does destabilize very much the banking system as well. Fourth question on the development of financial markets, how these new practices can impede or enable real investments, so real capital formation, so productive investments in the real economy. So I would say that while in the past, at the time of Keynes and still at the time of Minsky, you could still make the argument that in the upturn, higher leverage ratios were also contributing to producing more credit for the real economy. What I've seen over the past 10, 15 years is that the growth of private equity firms and hedge funds has gone along with the growth of corporate leverage in the non-financial corporate sector, which has been mostly geared towards increasing mergers and acquisitions, leverage buyouts, stock buybacks, and it's allowed zombie companies to proliferate. Zombie companies are companies that need to borrow just to be able to stay alive. You know, they're the prototypical Ponzi speculative units in a Minskian sense. So this type of finance is actually producing zombie capitalism. It's not really enabling real investment. And the last point on the distributional implications of my view of financial relations and conflicts, what it means to look at these financial relations as the greater debtors versus the lesser debtors, as opposed to creditors versus debtors. Well, first of all, it forces us to reconsider how we approach monetary policy when it comes to inflation and interest rates. Because it might as well be that very low interest rates or zero interest rates actually what's allowed this second wave alternative finance to proliferate in the last quarter century. So it begs us to reconsider how we approach the question of interest in the first place. And then it also forces us to reconsider. It's easy to see how the lesser debtors, the ones who just borrow to pay for their tuition fees, for healthcare and so on, how they lose to the greater debtors, to the absentee debtors. It's more difficult to see how the absentee debtors are also screwing upper class borrowers. So how the very rich and ultra rich are screwing the upper classes in this process. But to keep it really simple, you know, the main distributional implications that we can see here is that on the one hand, you have upper class investors who might take, you know, pleasure in seeing a 5 to 7% return on their portfolios of assets invested in stocks and bonds, without realizing that they're fueling and feeding the hype in financial markets that is, and they're buying into other people's bubbles that they don't see. And this is generating 30% return or 150% return for a very small elite. So, you know, it feels like you're doing 5-7% return a year, which is better than 0% return on owning nothing. But at the same time, you're losing to the elites, to the Bill Gateses that you're trying to emulate by a very long shot. So these processes are highly exclusionary, and they are shrinking the number of people that get access to a shrinking pie as well. Sorry, it took a lot of time, so I'll stop here.
No, thanks
thank
very
you.
much. It was very, very, very clear.
Thanks to both of you. And let's now turn, well, rather open the discussion. You are welcome to either raise your hand or write your question in the chat. Both channels are open. So whoever wants to, there you go. We have a first question from Emanuele De Girolamo. Please, Emanuele.
So
Nice
hi everyone. Hi everyone. So thank you very much for this very interesting presentation. Thank you, Stefano. And I'm very looking forward to read the book you're writing. And as you already know, I totally buy the idea of leverage power and shown through the history of hedge funds practices. As you can imagine, I have some question about, you know, like how you would conceptualize the history of subprime. I know you're working on it, and you know, you're saying that hedge funds are really focusing on very low risk assets, and I would like to know how you conceptualize the move towards risky assets that we witnessed in 2000s, right? In the 2000s. And if I can also ask you if you can talk more about how the move from creditors' power to leverage power happened, or which kind of actors were the driver of this process, and how hedge funds connect to this story. Because I really believe that the history of hedge funds is important, but I would like to know how you conceptualize the connection between, you know, the practices of their practices and the practices of banks. Thank you very much.
Thank you, Emanuele. Since Stefano has proved to be very good at taking notes of questions, I would suggest that we collect a few more. We have Stefan Eiche next in line. Please, Stefan.
Hi, everyone. Nice to meet you this one, Stefano. That was terrific. I learned a huge amount. I had three, I wouldn't call them questions, but just kind of prompts to invite you to say a little more. One is, I think, asking you to expand on something you kind of went through, and I just wanted to kind of hear a little more. And two might be areas that are just outside of what you're focusing on, and so feel free to just say, like, yeah, that exists, but it's not what I'm looking at. The thing I wanted to kind of hear a little more about is on the new orthodoxy and the new heterodoxy. Is the picture that you put forward one of endogenous money creation in a shadow banking system, right? So not commercial banks, but some form of shadow banks, which could be embedded in large banks, but it doesn't really kind of question the endogenous money story. Or I also picked up on something else, which is that actually some of the older orthodoxy elements seem to come back in terms of deposits or not. So what is the kind of new heterodoxy that you're proposing? How does that relate to shadow banking stories and endogenous money creation? And then the two things that are maybe beyond what you're doing is, at the very beginning, you defined leverage as borrowing to invest. And one thing that would be curious to relate to here is, you know, the idea to borrow in order to reduce your tax burden. Right, so that doesn't seem to immediately produce further investment, but it's obviously, in particular in private equity, a huge driver in decisions to kind of leverage up. So at the very least, like, are you focusing on one kind of leverage and there are others, or how does the tax story enter here? And then finally, just an invitation. It seems like the one area in which interest as a source of wealth accumulation seems to come back and not leverage is in that mysterious realm of private credit. I don't know whether I'm not quite sure I fully understand what private credit is, but it seems to be closer to an interest story rather than leverage. So maybe, again, you could kind of link that to what you're looking at. But that was wonderful. Thank you.
So please, Stefano.
Yes, can I, should I answer? Okay. Thank you, Emanuele. Nice to see you for your comments. And Stefan, nice to meet you. I love your book. So I'm going to address first Emanuele's comments. You're asking me to open up a whole new, so I don't know if I can really, in a few words, summarize how I see the subprime mortgage bubble and crisis in this presentation. I know the work that you're doing on historicizing the growth of the subprime mortgage industry, and I completely follow your story, and I just think that in the early 2000s something changes of a qualitative nature, and in the paper I do mention this, and I think that if I shared the paper with you and you read, that section where I mentioned the subprime mortgage crisis, I think that'll do much greater justice to your desire to understand better that, and certainly to the audience as well, which probably doesn't want to hear too much about the subprime mortgage crisis. But I will try and say something about how the move and when the move from creditor to debtor power took place. That's a difficult question because it presumes that I would agree that there was a time where there was creditor power prominent, and now suddenly this has been reversed. Whereas I have always approached the question of finance from a borrower perspective. And that's probably because I have always looked at banks in the first place, and I've always been fascinated with the role of banks. So I would say that historically, and this is going to be like, very, very big argument that I'm not making in my book or in any article anytime soon. But I'd say that capitalism, when it comes to the sort of the financial revolutions that we associate with capitalism, these financial revolutions have to do with creating conditions for enabling debtors' power vis-a-vis their creditors. And I think that even Katharina Pistor's book on the Code of Capital mentions that in passing. It's not a main point in her book, but she shows how, from a legal point of view, a lot of capitalist innovations have got to do with reducing the liability of borrowers, with reducing the ability of creditors to claim that due from borrowers and so on. So I would say that the point that I make in general is a methodological one. When I look at finance, I'm interested in looking at the power of borrowers. And I also struggle with the question of placing the creditors in this context. I had a couple of slides where I try to explain how in a capitalist economy, finance originates in relationship of mutual indebtedness. There's no creditor, and the creditor is something or somebody that appears at the end of these networks of relations. It's not really someone or somebody that initiates finance. A creditor is just, the person that receives money in exchange for selling their house to the levered up investors that is borrowing to buy the house. But anyways, this is a bigger sort of point that it's probably beyond the scopes of this presentation. So I would say that there is no specific shift in terms of creditor to debtor power, but there's definitely a shift in the growth and proliferation of alternative financial firms, hedge funds, private equity, real estate investment trusts, and this has taken place starting from the mid-90s, but especially in this 21st century. So we did have private equity and hedge funds already in the 80s or in the 60s or in the 50s, you could say, especially with hedge funds as equity-only funds. But the industry has really grown in the last 20, 25 years. And we cannot imagine this industry growth without looking at the general very low interest rate environment in which they're proliferated. Take that away and you don't have hedge funds anymore. And that speaks to the question of private credit that Stefan was mentioning his last comment. Stefan, you were mentioning how private credit is more close to an interest story again. And that is true because private credit has become, since interest rate hikes in the last couple of years, has become again a main outlet for investments which are not levered. It's just the interest rates are now up again, and there's plenty of non-financial corporations which are in dire economic financial conditions, and so they're very willing to borrow at very high rates, and this has become a source of short-term profits, and a lot of pension funds have bought into the private credit bubble. But this is already deflating now, as we have an expectation of interest rates being again slashed starting from this summer, possibly in the US. And I was just reading today an article on the Financial Times that is talking about this story of private credit and how this was due to this rise in interest rates, but it is indeed an interest story, and it's a big market. It's grown massively in the last couple of years, And it's certainly worth, mentioning. But it's my bet is it's a loser's market. And then you also mentioned how borrowing is one reason for borrowing is also to reduce your tax burden. And I of course, I agree with you. I didn't mention this in the presentation. I do mention this in the paper in a note. I think Martin Koenings, Lisa Atkins, and Melinda Cooper in the Asset Economy book, they provide, better context for understanding how fiscal policy and taxation plays into the financial strategies of households, and borrowing to reduce your tax burden is certainly part of the story. And I would say that, that is built into the story of leverage, because, as you invest in assets through the lever of leverage, you are in many ways reducing your tax burden, avoiding taxation, doing lots of things. So I should definitely highlight that element more. But I would say that besides the, beyond the question of the tax burden, which is very much contingent on the different tax regime you're subject to, there's a question of, taking advantage of free money, essentially, because, when you are a hedge fund, you borrow very short term, 2 weeks to 2 months, and you're borrowing at the lowest possible rate. So for the past 15 years, it's been free money. And you do it because that makes sense. That's the most rational thing to do. And your last point was on the new orthodoxy, heterodoxy, how this relates to shadow banking stories. So I, of course, what I was suggesting in the presentation was that money creation nowadays is very much taking place via financial market trading and financial capital market lending and so on. And the literature on shadow banking has done a great job at teasing out a lot of these dynamics and practices. But a lot of the emphasis has been on money market funds, or what I call money market saving. So a lot of emphasis has been on looking at how investment banks or big banks or shadow banks have been able to fund themselves in the money market as a way to then make loans and investment in the capital market and finance the subprime mortgage bubble and finance the corporate debt bubble and all of that. And this is an intermediation story told from a heterodox perspective. And you would find among, heterodox scholars that none of them agrees that market-based banking is actual endogenous money creation. And there was one of the last papers that I've checked on the Journal of Post-Keynesian Economics by Michel Bourguelis, I think, French, great paper, but he is really laying out, what's in the literature on shadow banking from an heterodox perspective, and he's coming to the conclusion shadow banking is intermediation. It's not genuine money creation. And Perry Merling has that built in his own view of shadow banking as well. So they're not really questioning what has become a mainstream consensus position by mainstream macrofinancial economists, because they basically say the same. They argue that shadow banking, market-based banking is financial intermediation. And in a paper, a 2019 paper, I challenged this view. But I guess I don't want to now go on and describe, why and so on. But you could have a look at that paper and see if it addresses your question.
Thank you. We have a commitment to finish in roughly 10 minutes, but we have another question, and I apologize, I hadn't seen it before, from Kainat Baskar. So I welcome them to take the floor.
Hi, thank you for the presentation. Really enjoyed that perspective. I have 3 questions, basically. So firstly, do you envision shifts in instability and risk dynamics with how the wealthiest individuals are hoarding wealth? Do you think, they can maybe become systemically important if they have such massive levels of wealth? Secondly, how do you see regulation evolving to address these kinds of debt or leverage levels in the economy if they're hopefully they're eventually recognized by mainstream policymakers? And lastly, so after the SVB crisis, there was a lot of speculation or a lot of conversation about how supposedly safe assets might not actually be as safe as we think they are. So do you think those kinds of conversations can bring changes in the leverage structures of these hedge funds?
Stefano, please.
Should I answer?
Yes, I believe there are no further questions, or at least no further hands raised. So please.
Okay, thank you very much, Kainat, for your questions. You are asking the most difficult questions, as I usually have no answer to the question how we fix this. And my wife is constantly been annoyed by me not providing solutions in general, including in the households for other things. I'm just pointing at problems. So I will try and say something. So the first question that you asked was, can this high net worth individuals, these alternative financial institutions, can they become systemically important? And the answer is they are already. They are already because bailouts, QE programs, they are meant to recapitalize, provide liquidity to a banking system, in particular to those big banks, those broker-dealer banks, which are lending to these hedge funds and so on. So we all know, it's now a well-known fact that the subprime mortgage bubble was also a CDO bubble, and CDOs were structured products, and the main investors in these products were hedge funds and the banks themselves. And then hedge funds progressively deleveraged their positions and shifted those CDOs onto European banks and Icelandic pension funds and so on. But they rode that CDO bubble in the first place, and then they shifted, and they started deleveraging, moving out before the market collapsed. We know that in September 2019, there was a major run on the repo market, which was called the Repocalypse by some financial observers. And this Repocalypse, which essentially caused a sudden spike of the repo rate up to 8-10% between 16, 17 September, caused the Federal Reserve to start pumping liquidity in financial markets, so resuming quantitative easing to the tune of 50, 75, 100 billion every other day. And between September 2019 and January 2020, so before the pandemic started, the Federal Reserve had already expanded its balance sheet by $400 billion to accommodate financial markets. And then it came out in a quarterly report by the Bank for International Settlements, and this was mentioned also by the Bank of England, that run on the repo market might have been caused by hedge funds doing their stuff. So clearly they are already systemically important, and clearly they have already generated a lot of responses by monetary authorities that have been forced to accommodate markets to keep them afloat, and so on. How can regulation address this problem of financial sector leverage of these entities? That's a very big question, and I have no idea. I don't have the qualification to be able to tell you what kind of regulation we need in place to address this sort of issues. But what I can say, which is a very broad and generic point, is that in my work, I've been trying to place the emphasis on how today's inequalities, conflicts, struggles revolve around getting access to these means of leverage or not. So if we want to find a fix to the problems of financial sector leverage, then we should try and reconquer or conquer for the first time the engines of leverage, the banks, the big banks that are enabling these processes, because they are, at the end of the day, the ones who are allowing for this to happen. And I don't know how we democratize banks. I don't know whether nationalizing them is, for instance, a good idea. I don't know how this can be done. But one thing is sure, and that is that since money has been free for them, literally free, negative interest rates for the past 10 plus years, except for the last couple of years, then perhaps we should start thinking about the possibility that money be free for all, not just for them, and that might level the playing field. So I know that we've not talked about CBDCs. I don't nurture a lot of hope for them, but CBDCs, bear the promise of interest-free money that can be created according to democratic decision-making processes. I doubt that that's what's going to happen, but that's something. So maybe, we'll see. And then the conversation on safe assets. I'm not sure I'm familiar with these conversations that you were mentioning on safe assets not being safe, but that's certainly a problem. And they're not safe precisely because they are a foremost object of speculation by these funds. And that makes them very safe in normal times, and the epicenter of margin spirals and deflationary processes in times of stress, when they should provide their function as stable stores of value the most. That's when they become the least effective. So certainly that is a problem that should be addressed. And I think I'll stop it there.
Thank you, Stefano. Thank you, Kainat, for the question. I see Massimo has turned on his microphone, so perhaps you want to...
No. Just maybe the rationale for an intervention, for a regulatory intervention, should leverage on the fact that leverage has not real effects. So if you want, the social meaning of finance is to facilitate the real accumulation. So if you can demonstrate, if you can show, if you can argue that this kind of finance has not any kind of spillover effect on real accumulation, but this would be the rationale for shrinking its scope and regulating it. So, in the name of a superior social interest.
I completely agree. It's going to be difficult because I don't think it's just a matter of convincing.
No. Not at all.
So we shall see, but I'm definitely not the person to ask for solutions. Sorry, guys.
Okay.
But I'm glad, Stefano, that you mentioned in your last answer CBDCs, because of course we are all assuming with this webinar series that CBDCs are the solution to all the problems we will be discussing throughout. So of course, I'm very grateful to you for this presentation and for the discussion. I think there could hardly have been a better way to kick off this seminar series. And I think that among all the different things, and I've certainly learned a lot. I see that also Carlo Di Politi, who has joined us in the meantime. I told you he is together with me. In fact, he is the principal investigator of this research project. So I'm glad we have him here, and I'm glad to introduce him to you. I look very much forward to continuing this discussion. I think that, as I was saying, apart from all the other things that we have learned, you have given us a big lesson in reminding us that the first thing that we have to do is change our way of understanding how the monetary and financial system currently works before we start trying to devise new solutions, even based on new technologies. So perhaps, Carlo, you want to add a few words? No,
I was only nodding to say that, yes, this is a great start to start our workshop series. Thanks a lot very much.
Good. So thanks to all of you, to Massimo as a discussant, and for all of you for participating. We look forward to our next appointment, which is in 2 weeks' time, and it will continue with Stefan Eich. I believe that Stefan has had to leave us, but he will be the next speaker on the list. So please join us in 2 weeks. Thanks again to all of you for this very great and stimulating conversation. Thank you, Stefano.
Thank you so much. It's been a pleasure. See you soon.
Thank you,
Bye-bye.
Stefano.
Bye, everyone.
Good
Thank
evening
you.
to
Bye.
all. Ciao.
Good evening.